So each of the federal banking agencies have created a process for appealing within the agency itself a determination by an official at that banking agency. And a lot of banks don't even know about this. They think that their only options are either to just beg the agency official to change his mind or her mind, or to actually sue the regulatory agency in federal court. But there's an option in between those two extremes. And a lot of times it can be faster, it can be less expensive, and it can be easier both for the agency and for the bank. And it's called the intra-agency appeals process. So today we're going to talk about the origin of that process and its purpose. We're going to talk about some of the concerns that banks have expressed about how the intra-agency appeals process works. And we're going to talk about what a bank needs to do if it thinks that it may want to take advantage of the intra-agency appeals process. Later in this video series, we're going to talk about, for each of the specific federal banking regulators, how their intra-agency appeals process works. Each of the federal banking agencies created an intra-agency appeals process in response to something called the Regal Act. So in 1994, Congress passed the Regal Act, and the Regal Act required each of the federal banking agencies to create a process for independently appealing within the agency itself an agency determination. And it required that the process provide for the review of what are called material supervisory determinations. And that's a term of art, but it includes any examination ratings, it includes any determinations concerning the adequacy of a bank's loan loss reserves, and it also includes determinations on loan classifications for any loans that are significant to the financial institution. The Regal Act also required that the process be independent. And the concern here was banks didn't want to be doing an appeal within the agency itself that went right back to the same person that made the initial determination. So the Regal Act required that any appeal of an agency determination has to go to somebody who is not directly or even indirectly supervised by the agency official that made the first determination. The Regal Act also required that the decision be made by the federal banking agency expeditiously and be heard expeditiously. And finally, it imposed certain safeguards. And the requirement here was that each of the agencies has to create a safeguard that protects the banks. And it protects the banks from any retaliation, either by a banking agency official or by the examiner for that bank. So why is there an intra-agency appeals process? Well, in short, it's because agencies can make mistakes. Regulators can make mistakes. And Congress realized that, and it passed the Regal Act to ensure that when an agency makes a mistake, or when a bank thinks that the agency has made a mistake, there's a process for resolving that without the bank being forced to resort to litigation outside the agency process. And that's really helpful. It's helpful both for the banks and it's helpful for the agency itself because it's less expensive, it's often much less contentious, and it's faster. And it also creates a mechanism that can be very helpful both to regulated banks and to the regulator because it helps ensure consistency between different regions. So appeals will often, where a decision is made within one region, the appeal often is done outside that region. And so it creates a mechanism where the agency sees differences in how different regions are making decisions. And it also can help when there's an inconsistency between examiners. So, every bank has experienced this, but different examiners will just have different instincts about how rules and regulations apply to a given bank. And so the intra-agency appeals process creates a mechanism where the bank can appeal a decision that seems to be based on one examiner's views that are very inconsistent with other examiners' views. And finally, it gives a bank sometimes an opportunity to really create a focused case for itself with respect to an issue when there's a surprise decision that is made by an agency. So sometimes an agency will make a material supervisory determination that will just surprise a bank, and the bank feels that it hadn't really had a fulsome opportunity to present its case on that issue before the determination was made. So the intra-agency appeals process creates an opportunity for that bank to assemble its best case and present it to the agency as to why that determination was incorrect. When banks are thinking about whether to make use of the interagency appeals process, often one of their biggest concerns is retaliation. They think maybe the examiner is going to be upset about the fact that I filed an interagency appeal and somehow take it out on the bank in a future examination. But it's important for banks to keep in mind that the agencies themselves created this process, and they created it specifically to avoid the possibility of retaliation. And that's why you have the requirement that any appeal be independent and be done by somebody outside the process. And also why you have strict rules against retaliation. So your examiner can be fired if they engage in a retaliatory decision after that interagency appeal is filed. And that same rule applies not just to the examiner, but to the examiner supervisors. Employees of banking agencies are not allowed to engage in retaliation. It's considered unethical, and it could result in them losing their jobs. One implication of that, because of those dire consequences that can apply to any examiners that engage in retaliation, is that after an interagency appeal is filed, that examiner has a strong incentive to ensure that any decisions the examiner makes in the future are well-reasoned and couldn't reasonably be viewed as arbitrary or retaliatory. And finally, it's important to keep in mind that this whole process, the interagency appeals process, is really in the interest of the agency as well as the bank. It's a mechanism that was created that is much less burdensome on that agency than alternate mechanisms such as litigation. So if a bank is thinking that it might make use of the interagency appeals process, what should it do? The first thing is to be aware of the deadlines. So they're relatively short, generally within 30 to 60 days of the determination that is being appealed. And it's important for a bank to know what those deadlines are and to promptly request extensions from the agency if they think they won't be able to file the appeal before the deadline occurs. The next step that should take place is you want to consult as quickly as possible with your counsel concerning whether or not the determination that you want to challenge is even appealable. Different agencies have different rules on what is and is not appealable, and not every determination by a banking agency can be appealed through the interagency appeals process. An additional thing that you want to be doing really at the same time as those first two steps is obtaining permission to share confidential supervisory information with your counsel. So there are rules that govern the ability of a bank to share confidential supervisory information with counsel, and the bank has to request authorization to do that. And often, because of the nature of material supervisory determinations, there will be documents that qualify as confidential supervisory information that counsel will need to see in order to finalize your interagency appeal. The last thing that you want to be doing is just assembling all the documentation that you have that relate both to the decision that was made by the agency and that would support the position of the bank, so that you can provide that information to your counsel and enable your counsel to make the strongest case for you that is possible.